Hello, this is Jesus Dominguez from Valentum. Today we're gonna show our next investment idea. This will be the third one. We started with Tower International, we continued with Global Dominion Access, and today we're gonna present Regus. You can find the videos in our website. Just a quick reminder, what is Valentum and what do we do? Valentum is a value-oriented long-only fund, and we look for companies with high free cash flow yields and low levels of debt, with good management and sectors and businesses which we can understand. So let's go to the idea. The idea is Regus. Regus is a company that manages business centers around the world with more than 2,800 centers in 1,000 cities and 100 countries. These are the brands that Regus uses from the brand Regus, which is more professional and allows you to hire meeting centers or meeting rooms, or have your office and your company with not only one seat but several work seats. And it goes through the open office signature spaces, Regus Express, which is more into airports and rail stations. So it covers more or less a wide array of necessities that a company can have. One of its main differences in relation to competition is basically the worldwide footprint. There's a lot of competition, and it's a growing competition basically because we believe this business is a trend that allows all of us, and when I mean all of us is everybody that works in an office. It allows you for higher flexibility. If you're a startup or an individual that only needs a small space, and that you may need more space in the future, but that the company may go bust because it's small, or because you're a large client and you want to set up an office in a new country, and you just want a few workstations there, so you're not gonna go into a long lease in an office, and you prefer to go together with Regus. As you can see, 40% of revenues come from the United States. There's a large capillarity in the UK, where they make 20% of revenues, and the rest come 20% from Europe and 14% in Asia. They really do have a very good network in the United States, where a client can travel around the cities in the country, and in most of the cities, or the important cities, have an office. And it works also in the UK, and around Europe it works, we believe, as a region. Let's say if you work around Europe and have clients in Germany, France, Spain, UK, then Regus has a global network. But for example, if you look country by country, in just Italy or just Spain, maybe you only have Regus in the main cities yet. Okay. Maybe it's worth talking a little bit about the history of Regus. It was founded by Mr. Dixon in Belgium, because he went there for work, and he saw that he couldn't meet in any office. He had to go to hotels, to restaurants. I think it's something that has happened to all of us at some point. So he decided that maybe he could set up an office and lease the rooms by hours for meetings, or for people that wanted to work there 1 day or 2 days because they were traveling. And the idea started to work back in 1999. They started to expand through Latin America and Asia, and they IPO'd the company in 2000. Then in 2001 they started acquiring. They acquired Stratis in the US, and in 2002 they started to have some difficulties. This is because they went too heavy on the West Coast in Silicon Valley, and when the dot-com bubble started to burst, well, occupancy fell, and they started to have the financial problems. So they had to sell a stake in the business in UK, which was the business that has always worked, because it was more spread regionally around the cities and didn't have an exposure to one sector like they had in the US. And they ended up filing for Chapter 11. They reorganized the company, and they were able to exit after the sale of 58% of the business in the UK. And after that, well, they started acquiring some other companies in the US, different companies, in more, increasing the footprint of the company, and they continued the expansion throughout 2016. Now, and this is something that we like companies that have had trouble, and that even if they've filed for Chapter 11 or gone bankrupt, because we believe that when this happens, the company learns, and they learn something. So we believe they learned about having a better geographical exposure, and we believe, and this is one of the keys of the company, that they've ring-fenced everything. When they set up a new contract with a landlord, they set up an SPV for that location, that particular location. So if things go bad, they can leave that company, that SPV, fall in an extreme case. But the landlord never has the right to ask for further guarantees to the holding company. So this is really important, and it's they either do this or set up a 6-month exit window. This is less likely to be seen, and most of the contracts are ring fenced, which is the usual contract that they do, and almost no landlord accepts the 6-month exit window, we believe. And now they are turning around a bit the costs. They want to lower their fixed costs, and the higher fixed cost in this company is the lease, because at the end of the day, you enter into a long-term lease contract, and you rent that space for the short term. So there you have a mismatch and a risk in terms of timing. So what they're doing is they're trying that the landlords co-invest with Regus, and this is great because Regus lowers a lot its risk. It lowers a little bit their margin, of course, but what's important is that the return on investment is much higher, because the one that is investing is the landlord in the big part. Let's say that we believe that in new centers where they co-invest, Regus invests, we believe that between 0 and 20%. So 80% goes for is invested by the landlord, and this means that Regus has lower debt, and that all the cash flows from the mature business will go to reduce the debt, and there's not such a big need for growth capex. We will talk about these things in a while, but basically what we want to show is that the business model generates a lot of cash. The conversion is above 100% EBIT due to the low capex, because what we were saying, that they are amortizing more than what they are investing due to the co-investment idea. And they've got, of course, negative working capital, because there's a 2-month guarantees or prepayment from the clients, and Regus is the one that's managing the centers. So Regus is the one that gets the prepayments, not the landlord, although the landlord gets a higher part from the net result. And we want to highlight here that how it works It's basically you get your revenues, and from the revenues you start to take out all the overheads, indirect costs, personnel. You take as well the margin of Regus, and after that the result that you get, 80%, let's say, for example, in a co-investment center, around 80% would go to the landlord and 20% for Regus. But you've already taken away a cost which is like Regus cost, Regus royalty, call it whatever you want. That we believe is a significant part. So you end up getting a very nice margin with a much lower risk. Here in the chart, we show the cash flow before net capital expenditure, and this is how we're going to look at the business model. We're going to take the mature centers, the EBITDA that they generate, and the cash and the capex that they need to maintain that business, and we're going to get a free cash flow of that part, and then we're going to value on a separate as a separate part the new centers. To give you an idea, more or less, a center takes 2 years to reach maturity. I'm going to take away this. The new business centers have negative margins, as I was saying, the first 2 years, but then they reach maturity on the second year. So what we think is that the highest risk is the cycle. So if there's not a deep downturn in the cycle on a worldwide level, because remember that now the company has a very large footprint and it's more diversified. If there's no such downturn in the cycle, the company should continue compounding. That's the idea behind Regus. Here, what you see is the return on investment of the net investments in, let's say, in 2014, and the return on net investments in 2015 that were of the centers that were opened in 2011. Let's say the return on investment obtained in 2015 was 23%, and those centers opened in 2011 yielded a 20.9% return on investment in 2014. And of course, the ones opened in 2012, the returns in 2014 and in 2015 were lower because there was one less year of maturity. So between 2 and 3 years, around 2 years you break even and you start generating, and we would say that around the third year you start to reach your cruising speed returns on investments. Here there was a big issue last year because the company they were growing very aggressively. It opened 32% more centers in 2014 and 24% in 2015, and they showed this chart here on the left with the logo of McDonald's. And basically what they were saying is, I think it was Mr. Dixon who said this, but he said, what are more people that in the world that eat McDonald's, or more people in the world that work in an office? And of course there are more people that work in an office. So he said, then this is the potential of growth of Regus. So everybody was a bit scared and thought these guys are going a bit crazy and they're gonna invest really heavily and they're gonna in-debt the balance sheet, and this is very risky strategy. The truth is, when you talk to them, was that and they set up a limit of net debt to EBITDA of 1.5, and around that time they were around 1 time. The truth is that when you talk to them, they said that 1.5 times net debt to EBITDA was the limit, but that they were not going to reach it. And quarter by quarter, you saw that the net debt to EBITDA not only did not increase, but it decreased. So we thought, number one, that there was maybe a mistake in the communication on that year. And secondly, if you see this growth, 32%, 24%, these are very high growth rates. But if you look at how they are growing, you see that the growth makes sense in a way that if you go into Madrid, where we are based, and you see that there are 4 centers of Regus, and the occupation is very high, so they open a 5th. That means that they're growing by 25%, but it's one more center in a city which occupancy is very high. Then you've got the other type of growth when they open in a new country or in a new city and they open one business center. So when talking to them, we were quite relaxed and haven't said this, but we've owned Regus since 2014. And when we were talking with them, we thought that they were using common sense when growing, though. So though the number seemed really high, when you look at it side by side, it makes a lot of sense. However, 2016, maybe there's more economic uncertainties, there's a bit of a slowdown in certain regions, so they have slowed down that growth. And they've been very quick in saying, look, there's Brexit, there's the US elections, there's many things around Europe, so we are slowing down our growth. And we like that because they are showing that they are not going crazy with growth. Okay. But their strategy in the long run, we believe, has a lot of upside. And this is a sector view that we don't usually make bets on sector, and this is not a bet on a sector, but is what we see, that there are more people, more professionals that work in office, that work remotely, that travel more, that have clients in different countries, and there are more large companies that want to use that space in a more efficient manner. So the co-working, flexible working spaces, or however you want to call it, makes a lot of sense. And it makes sense from, as I said before, from startups or very small companies up to very large multinationals that want to set up in a new country. Okay, so the real target or the real mission of the companies is to provide with flexibility and efficiencies to clients that at the end of the day want to lower their fixed costs and want to be more flexible, and want to be more flexible to grow, more flexible to go in and out of a country, of a city, of a region, and to move around the world. This is the Verizon example. I think this is key to the investment to understand it. This is an example that Regus uses because the company allowed them, but we believe that there are more agreements similar to Verizon. Basically, Verizon is moving, or it's transforming its real estate portfolio, moving into Regus locations across the country, across the US, and they are lowering their real estate cost thanks to the flexibility that Regus is providing. When you've got many employees that are traveling around, maybe at the end of the day you can get less overall space and get it used more efficiently. We believe, and this is thinking out loud, that, for example, companies such as consultancy, audit companies, that are, at the end of the day, companies that are based on human capital, and human capital that is moving all around, is and should be a very good clients or example for Regus to improve and to get a higher proportion of large clients to occupy their spaces. When as they grow on large clients, which we think is what they're doing and where they are centering their efforts, this will make also Regus more stable, because when you've got many small clients, at the end of the day, well, it's more risky that they go burst and that their activity does not continue, right? So if we look into competition, as I said, it's very local. There's not many peers or companies similar to Regus that you can look the data very much into. Many analysts and many people compare Regus to the service providers, to the recruiters. These guys, they all trade around 8 to 10 times EV/EBITDA. Regus is more towards a 6.5. There's one company, and this is the one that we think that is more similar and comparable to Regus, which is Surfcorp in Australia, though they only have 150 locations around the world, and they're much more focused to Australia and Asia. And they're not so much into growth as Regus is. So you see that Regus is a larger company, is more has a higher rate of growth, and is much more cheap. So with this first view that we are showing here, you see that maybe something doesn't make much sense, right? And then, of course, we have the case of WeWork. I don't know if you might be familiar with WeWork, but WeWork is a business center company, just like Regus, though let's say it's more into social networks. They try to mix up more people. They organize trips and weekends together, and they sell that. They try to get people to cooperate more deeply in their spaces. However, it only has 77 locations. It expects to have 376 more by 2018. They've got 5,000 members, and their expected revenues were $500 million. Okay, so it's like a small part compared to Regus. However, when going into valuation, this company has been valued in up to $16 billion. Regus is we say here less than 3 billion, but is more near 2 billion right now. So seriously, this is another example that we see that the industry is trending up. Many people want to use this. Everybody is into it, and we've got this company, which is the largest in the world with the largest network, trading at very cheap multiples compared to their peers. Let's go into the ownership, and here we want to show two things. The first one is that management has skin in the game, okay, and then we want to talk specifically about two of the managers that hold shares. The first one is Mr. Dixon, the founder. He has done a couple of placements in the last years. The last one was done in October this year, 2016, and previously to that, 1 year ago, he also did another one. He placed around 3% between 2 and 3% in each of the placements. The answer to our questions has always been that Mr. Dixon is fully into Regus, that he wants to be the largest shareholder and control the company, but that he wants to diversify his family office. what we know and what we see and the conference calls that we listen to and from our conversations with the company, Mr. Dixon is a hard worker, very much into the day-to-day of Regus, of the company, setting up new ideas, thinking about reducing costs, and he's very much into setting the KPIs of the company. So we do believe that he will stay, and maybe that he has just sold to diversify. We think that the way of doing it hasn't been the best, and this has caused, and we will see it in a while in a chart, this has caused the stock to fall. Okay. The second person that we want to talk about is Dominic de Daniel. Dominic is the new CFO. He's been for a few months already in the company. He replaced Mr. Yates, Mr. Dominic Yates, and Mr. de Daniel for us is a really valid CFO. He's been CFO of Adecco, and he did a very good job there. And we believe that he's introducing several measures into the company that have one target, and that one target is to improve return on investment. And that is the key of the company. The key of the company is to grow, but growth is not anymore the first KPI. So individuals in the company are not paid by how much they grow their center, but by how much return they get on the investment on the centers. So we now see that the company is aligned into improving profitability and into generating profitable growth only. We think that this might be one of the reasons why growth is not being huge this year, because maybe they want to raise prices on those offices that are not as profitable, and that creates an improvement in the margin, but maybe a slightly lower sales in some centers. So these kind of things are key for us, because when we invest in the company, we're looking for the return, for the free cash flow that we get, and looking into the capex that the company will have to make. So if the company is looking down into each center, how much they invest with the co-investment, they are reducing it, and how much they get, and they get personnel deep into the negotiations, and they tell them that what they need is return, not more occupancy. We think that this is going to result in higher cash flows and a more solid business model and profit and loss account at the end of the day. So let's go into a bit of the financial analysis of the company. Okay. As I was saying, the investment key is the growth of profitability. And this will come as the new KPIs are implemented, and as mature centers keep a sound occupancy, and as the new centers turn mature and start to generate free cash flow from a cruising speed, as I said before, around the third year. So it is important that, as I was saying, the new openings are done in cities where they see the need, either because the city has a very high occupancy rate and they see the space for a new center, or they go into a new city or a new country because one of their big clients says, hey, Regus, we're going to open business in this new country. Would you be interested in setting up an office, and we will occupy 20, 30 workstations, or 20-30% of the place. So it's a very good start for Regus to set up a new business in a country that of course they have to see that it's interesting for them, but on day one they have a good occupancy from one of their big clients. In this chart you see how mature centers grow, and the revenue per center is falling, both in mature centers and in new centers. It's the way to measure centers is the best way we have, but if you recall the first slide that we put where you saw all the brands, there was one that was called Regus Express. What I'm trying to say is that they are opening more new centers that are small. So probably this line should be measured as revenue per workstation, not per center, because there are more centers now that are smaller. As you grow in capillarity, maybe into smaller cities, centers are smaller. So it makes a lot of sense that the revenue per center is smaller. What we want to look into, as I said several times, is the return on the investment per new center. If we look into a bit the numbers of the mature centers, you can see here what I was saying, how the sales per center are falling a little bit, and we expect them to remain at these levels or a little bit lower. And EBITDA, on the other hand, or EBITDA margin, is growing. It's growing because the company is having a strategy of profit growth, profit improvement, and this is exactly what we want to see. So don't get misguided if growth or organic growth is not that high, because we think that there are other things to look at, and that organic growth might even be affected if there's a change across the organization looking into higher profitable growth and not only into higher growth. However, organic growth is very important because it's the key to profitability, and organic growth means higher occupancy rates. So they have to find a way to continue growing, but every new workstation, or every time the workstation is rented or leased, it has to be profitable for readers, and it has to create margins. And of course, the key is that returns are higher. If we look into the same slide as before, but for new centers, we see that the number of new openings had increased a lot in 2014 and 15, as we said, but that it's going down in 16, and it is expected to continue going down in the sense that they're opening less centers in 2017 and 18. So what this will create is probably a lower growth profile for the company, but it will also require much less capex because you're into less new centers, and those new centers are more invested by the landlords. So we expect the new centers to have a much lower drag on profitability in the following years than what we've seen in the last few years. Again, if we look at capex per type of center, we see that the growth capex per center is smaller. So this reinforces our idea that, and what they are saying as well, it's not only us that say it, that they are opening smaller centers with less workstations. So that makes sense with the fact that the revenues per center are a bit lower as well. However, maintenance free cash flow is improving. So I mean, altogether makes a lot of sense, and we think there's no flaw in the numbers and no risk that we're seeing in the numbers. Well, just to repeat the idea that the key is to grow, but not saturate the certain markets. So if you want to grow 20%, that's because your occupancy is really high and you need one more center per city in whatever region, or you're getting into new countries. Here, again, the capex per center decreasing as well. Growth capex has its trends with 13, 14, and 15 big years, but with smaller centers. Sorry. Okay, this slide is probably the most important slide to understand in a chart what we want, what we are seeing in Regus. The blue bars is the free cash flow generated by the mature centers, or even worse, it's the free cash flow generated by the EBITDA of the company, which is the EBITDA of the mature centers less the EBITDA losses of the new centers, and taking away working capital, taking away taxes, taking away financial costs, and taking away only maintenance capex. So it's more or less the free cash flow of the mature business, taking away the EBITDA loss of the new centers. And what we try to show is that this company is a compounder. Okay, you see the growth capex, but you see that the growth capex results in an improved mature free cash flow. Why? Because this capex here in 2010 means more maintenance free cash flow in 2012, and this capex in 2012 means more cash flow here in 2014, and this expansion capex that we had in 13, 14, and 15 will definitely mean more free cash flow in years 16, 17, and 18, and it's what we will start to see this year, with maybe revenues that are not growing as much, but with a very strong and powerful free cash flow number. Okay, this is for us the key, that this company is a compounder and that investments make very, very decent returns, very much into high double digits. We think that more near 20% in mature centers. Okay, so let's go a little bit into valuation to see how we look at the company or at the stock in terms of value and upside. As I said, free cash flow generation before expansion capex is what we look at. If you look at the free cash flow with the maintenance capex for 2016, you're already seeing a 10% yield and growing. And if you put the growth capex, that yield is still very, very, very reasonable. Okay, and this is taking into account that the net debt to EBITDA is really low. It's as low as 0.5 probably right now. So how do we value Regus? We do a DCF more than peer multiples because we don't really have peers, and we do a sum of the part valuation between the mature business and the new centers. So if we start with the mature business, or let's explain before why we do this. The business is exactly the same, but mature centers are just cash cows, and we assume, and this is the assumption in this valuation, that new centers will end up generating the same level of cash flows or similar level of cash flows than the mature business. So maybe overall you can see it's a bit expensive, though not even anymore. And when we analyze independently the mature business, as we saw in the previous slide, it's it's very cheap because it's a compounder, and really the mature centers are generating a lot of cash. This is the mature business valuation, how we are looking at it. Okay, what we get is the EBITDA, and that EBITDA of 358.9 that we show is the estimate that we've got for the whole EBITDA. If we used only the mature EBITDA here, it would be 407 million pounds. So there's around 50 million more. Okay, but let's be conservative. We take away financial expenses, we take away taxes, and we reach an operating cash flow here of 305. We've got and we're not here. I want to mention that we're not doing anything with net working capital. We expect an improvement in net working capital of 50 million this year, but that would be a one-off of the improvements that management is or the measure that management is putting in place. But we want to show here a free cash flow that should be sustainable, so with no one-offs. Okay, so we reach an operating cash flow of 305 with a maintenance capex of 77. We reach a free cash flow of mature business of 220, almost 8 million pounds. Remember, with the EBITDA of 359 instead of 407, and without the improvement in working capital. If we value this at a target 7% free cash flow yield, which is very reasonable, and what, for example, the Australian peer is trading at, and what we can see at market valuation of staffing company, for example, we see that the company would be worth 337p per share. The company is right now trading at around 230p per share. So only the mature business with what we consider are conservative numbers would be worth one full pound more per share. Okay, so what can we do with the new centers? As I said, new centers do not reach maturity until year 2. So we have to look for a way of adding the value that it generates after that year. What we've done is basically look for a target return on capital employed. The company is generating around 15% of capital employed, including the drag of new centers. So and we assume that more or less every center, when it's mature, it can reach a 20% return on the capital employed. Of course, if you assume that the company just stops investing in new centers, the returns skyrocket, right? So what we do is that we assume a 15% return on the new centers going forward, and this return should start to kick in on year 2. Okay, so we think we're being conservative, or let's say realistic. We assume 3 years of investment, and we bring the returns with a 9% WACC to present value. So if you want to see it to show it in numbers, this is the way we do it. Basically, here looking at the expansion capex that we assume for each of the years. The 2015, that's already made. 2016, almost a real number, and what we expect for 2017. And these are the returns that we get at 15% return on capital employed. We add up all the returns, we discount the returns to present value, we include a residual value using a terminal growth rate of 1.5%, which, well, it's okay, we believe. We never use terminal values above 2%, and we think that with these centers and taking into account that we are taking that 1.5% on the third year for the investments in 2015, but only for the second and only for the first year for the investments done in 16 and 17. And from this we take away the net present value of the investments done. We get a net return, and almost 50 cents per share of value is what we get from the new openings. Okay. If what we've done here is a sensitivity analysis to try to show where we stand depending on the scenarios that we get. Our target valuation, and we really believe that this is using conservative assumptions. We're not stretching the valuation or doing anything strange. We get a 3.4 pounds per share for the mature business, 0.48 for the expansion, and we take away 0.2 of the net debt of the company. So we reach 3.7 pounds per share, or 370p's. That is how the company trades in p's. And basically here we show that depending if we go to returns on capital employed of 20%, or let's say a worst case scenario of 10-11%, we get between 0.8 and 0.2 valuation per share of the new business. And if we go for the mature business, if we go to a worst case scenario when the mature business is trading at a 10% free cash flow yield, which is a level where we do not find that many investments, and that we like buying investments at that level, would be 2.36, more or less what the company is trading right now. And if we go to a 5% free cash flow yield, it will go up to 4.7 pounds per share. So this is the range of valuation range that we get, between 2.56 and 5.55. So we really see here a company which is a compounder, which managers are doing things correctly, where investments are returning cash flows for the shareholder, where they are deleveraging, where they are cutting risks by ring fencing and by trying to get exit windows, and in a sector which we think is in a very good trend. So we really like this investment. For us, this investment is one of our best investments, and we are very, very happy to be invested in Regus, where we think that the stock will perform very well in the next few months. Here is what we've done. Basically, we invested back in 2014. We started investing. The stock fell, and this basically we believe is due to the McDonald's slide and the 1.5 net debt to EBITDA limit that the company set, and that we thought wasn't very well understood by the market. So we bought more down here, and then it had a very nice performance, the company. So back in 2000 and late 2015, maybe we started selling some around here, around the summer, around £3, and we continued selling a little bit more, around 3.5. And now here, in October, you see the start of the fall. The space here is the placement of Mr. Dixon, and after that, the stock just continued to fall. So what we did was call them a few times. We had a meeting with Mr. Dominguez back in Switzerland, where he's based, and well, he basically solved all of our doubts. We think that all the things that we believe are there and are there to stay. That of course there's a risk, there's a cyclical risk, but we don't see economies, falling into recession and all at the same time. So we've basically doubled our position. Now Regus is around 9.5% of our fund. It's the second largest position, together with Global Dominion Access, the other video that we posted very recently, and that you can check on our website. And we think that this will be one of our best stocks for next year, because here at 2.3 now today, we believe it's much cheaper than at 180 here back in 2014, because the company is generating much more cash, and the company has much less net debt. So at the end, the ratio of free cash flow yield on enterprise value is much higher right now. This is just a long-term performance of the company, but nothing really interesting here. And the risks, yes, it's a cyclical business, but as I said, they've lowered debt levels, so they are de-risking a bit the company. We have to take into account that if the cycle starts going south, there's not only a risk of lower occupancy rates, there's also a risk of net working capital, of those 2 months that you're getting prepaid right now that you will have to give back. So the free cash flow cycle, of course, will turn more negative than revenues. And of course, the expansion plans carry a risk. The good thing here is that they're ring fencing everything, and if the cycle turns around, they can exit some of these SPVs. Though in the last few years, we haven't heard about SPVs falling and anything happening. So we think this should be limited. At the end of the day, Regus is not a day trader on new centers, so we think that they will maintain the center and until they see that the center is really is in a loss and the returns are negative, and at that point we believe that they will cut those SPVs. The barriers of entry are low at a local level, not that low at a worldwide or global level, and we think that large companies are the key to success in this company, and to have being more defensive and a bit less cyclical. And of course the competition has different concepts, so we believe that there's still space for everybody, and that there's a trend in the market that will continue making profitable many of these companies. But Regus has to keep an eye on every market and be very specific on the actions that they take on every region. Sorry. So this is basically our presentation of Regus. I hope you liked it. If you have any doubts, please do not hesitate to contact us. We will be more than happy to discuss Regus in depth. And thank you very much.